raise your hand or do whatever you need. So I like to start with some pros and cons of renting versus owning. It's pretty simple. The biggest pro of owning a house is that equity, that financial secure future that you can have for yourself. It's one thing to rent a home. It's another to own. 10 years, 20 years, 30 years down the road, you hopefully have paid your home off and you have a $200,000-$300,000 asset that you can use to purchase a new home. If you can downgrade and have a little bit extra in your nest egg, that kind of thing. So home ownership provides you that financial security. The con to home owning is there are extra expenses involved with it. You are primarily responsible for any maintenance, things that you don't have to be responsible for when you're renting. When you rent, your AC goes out, you call your landlord, they pay to fix it. When you own a home, if it goes out, it's on you. You have to make sure you fix it yourself. Donnie, do you have anything to add for that one?
No, I mean, I think that pretty much covers it. I mean, I don't know how many people out there have, I've heard countless times, people say, wow, I've rented all these years and looking back, I've got nothing to show for it. All I have are receipts for every month where I'm throwing sometimes thousands of dollars away and not gaining anything from it. So it's nice. Once you do own something, there are additional responsibilities that come along with it. But along with that also comes your equity, and you're able to look back at something and say, wow, I bought this house for X, a couple years ago, and now it's worth this much. So it's a great investment tool as well. So, that's really about it. David, I'll give it back to you. If anyone has any questions, feel free to post in the chat box as well.
Actually, I do have one question then. So if somebody is unsure whether they should own or rent, are they able to come in and sit with you and you kind of calculate cost with both insurance and, their monthly mortgage payment, and just to make sure that they are able to do that, to own? Because I think for a lot, sometimes they don't realize all the expenses that are included. So they might think, oh yeah, my salary covers the mortgage payment, but there are other factors involved, your taxes and that. So is that something that they are able to come in and sit with you to go over that, so you can make sure that they are covering all the expenses of home ownership?
Absolutely, Nancy. Yeah, we like to sit down with people and go over all of their goals, see what they're trying to obtain, how much they're looking to spend. And then we are able to provide them with an estimate to show them not only what their principal and interest payment is going to be, but also taxes, insurance, maintenance costs. That way they've got a clear understanding, a clear picture of not only what it's going to take them to get into the new home, but how much it's going to cost them afterward and what that is in comparison to what they're paying in rent.
Awesome. So the next thing talk about the credit. I think this is probably the most frustrating part of any loan process, whether it be a mortgage, on an auto loan, anything like that, is understanding your credit, what it means, how it works, why it's high for one time, and then 2 weeks later it's low for another lender. So just like with the getting the estimates as you guys just described, we'll have that consultation with a potential buyer as well. One of the main factors I like to tell people with their credit isn't so much how it's developed. You can see in the slide, it kind of breaks down how it's developed, but it's more of what you could do to impact it. And two of the biggest factors for impacting it, for me at least, are time. So a lot of the times it is purely having good credit, good pay history, and then waiting the amount of time it needs for your credit score to continue to go up. And the second factor, which I think is probably an immediate thing you could do to impact your credit score, is your credit card utilization. A lot of times people think, oh, I pay my credit cards on time every single month. I never miss a payment, but their credit cards are maxed out. That actually is ultimately hurting your credit. What they really want is to see the utilization. Now, from what we've heard from the credit bureaus, they are looking for 30% or less, meaning if you have a $1,000 limit, they want to see your balance at $300 or less. And that's something that you can do to have almost an immediate impact to your credit by reducing that utilization ratio.
So now, then let me ask you, with that, would it make more sense then, I'm not telling people to get more credit in that, but instead of having one card and they, let's say it's $1,000 is just for the example, and they have $500 on it, would it be better to have two cards that are each $1,000 and only have $250 on each one? Because it's less than 30% of how much credit you have.
So Nancy, that's a great question, and the ultimate answer to that is yes. A lot of times, believe it or not, opening a new account can actually raise someone's credit score. Opening a new account initially can drop your credit score just by the credit inquiry and the new account associated, because that will reduce the length of credit history that you have. But ultimately, if you're expanding your credit limit overall and reducing your total balances, that will lower your utilization percentage. So yes, you are right. In some cases, we don't necessarily recommend that every time for everyone. So we do, definitely recommend that you consult with your loan officer and based on your overall credit history to see if that's something that may benefit you. But the short answer is yes, sometimes that can actually help someone's credit by opening a new account. Hey, David, there's one other thing.
Go ahead, Don.
One other thing I want to throw out there in regards to credit. A lot of things we hear a lot of the time. Credit Karma says this. Why is it showing different with your bank? The easiest way to explain that is your credit score, depending on what it is you're looking to purchase. So your credit score may be different when shopping for an auto loan or credit card versus what it is when shopping for a mortgage. Your credit companies, the credit, you'll see them at the bottom of your screen, Equifax, Experian, TransUnion. Those are the three credit companies, the three main credit companies, or the credit agencies or credit bureaus. But the model that they use to pull your credit score can vary depending on what it is you're looking to apply for and what model's being used. The metaphor that I use is it's the same as going and buying a Chevy truck versus going to buy a Chevy Corvette. It's the same make, it's the same manufacturer, but it's a different model. So, Credit Karma is a great tool. I always recommend it to any customers or clients to help look at their credit and review their strong points or where they may need. But just don't count on that to be your actual and accurate credit score every time. It may vary when you're looking to apply for a mortgage.
And to piggyback on that, Credit Karma is a great tool to see what direction your credit is trending. Although the score itself is not accurate, as your score on Credit Karma starts to grow, your scores within the actual credit bureaus, depending on the mortgage product, should be growing as well, and vice versa. If it happens to be dropping, then you know that that's a bad sign. Something's happening on credit that you need to go fix it. All right, so the next topic we talk about is how much you want to spend. So starting off from renting to owning, your pros and cons. A lot of people see how high rental prices are right now, especially in Palm Bay. I know looking at a 3-bedroom, 2-bath house, a lot of time rents $1,600, $1,800. And they know they have friends or family that have a similar house and their mortgage payment is only $1,300 or $1,400. And they think that ultimately that'll help them, that they should be able to go do that. Well, it is a hot market, as Nancy said. The houses are flying. They are lucky to be on the market for a week or two at this time. So what happens is that the prices go up, and because demand is high. So we will have that consultation. We'll actually go over your debts, go over your income, and relate those two with your credit score and potential interest rate to determine how much can you actually afford. Some people want a $300,000 house, but in reality, all they can afford is $270,000. So they need to know that you need to know where that is so you can make an informed decision.
And David, just to piggyback off of what you said, the opposite sometimes is true. Whereas a lot of times we can pre-qualify someone, and based on their debt to income ratio, they may qualify for a home that's so much, but they don't necessarily want that high of a payment. So that's another thing that we do, another service that we provide. When we go over what your estimated projected payments are going to be, we make sure that not only you're eligible for it, but that it also meets your goals and what you're trying to accomplish. If you're looking for a mortgage payment of $1,200, but what you qualify for, your payment comes in at $1,700. Obviously, if that's not in your budget, that's not something you're going to want to do. So we want to make sure that that we've got you on the right track for not only what you can afford, but what's realistic to fit your budget.
Well, isn't that one of the problems too, is that often people become house poor. So they've just sort of made their budget to make their payments, and they don't have a lot extra for essentials or things that come up. I noticed on your slide there, it says a rule of thumb is to have at least 3 to 6 months worth of expenses. And didn't they say when the pandemic hit, about 40% of the population had less than, what was it, $400 or $1,000 to be able to access, which is kind of a scary statistic, actually. So that's really good advice to have, that extra months of expenses, because you never know, and especially buying a new home or getting into a home, there's always things that come up that, you just didn't prepare for that you have to purchase. So good advice.
And you're exactly right, Nancy. I think one of the most common things that I hear is when we talk about down payment, a lot of times first-time buyers may only think that that's the only thing required to bring to closing. I'm sure David's probably going to cover this in one of the next slides. There we go. Yeah. You've got your true cost of obtaining a mortgage. Not only you have your closing costs, which for first-time buyers, can be as little as 3% down. And a lot of times under a lot of our different products, we can either have those paid in a different way to help you pay the down payment. But you also have your closing costs, your escrows, and your prepaids. Your closing cost on the buyer side as well as the seller side. Your escrows are the money that's set aside each month to help pay your property taxes and your homeowner's insurance. Those things can be included or escrowed into your payment monthly to be paid out each year, but they also need to be collected up front at closing to make sure that there's enough money in your account so that when those things become due, they can be paid. And that's what's called your prepaid. So we charge, or we collect rather, your prepaid items so that we have enough money in your escrow account. When those are due, we can go ahead and pay those for you.
Yeah, I like to, when we have these consultations, some of those costs we don't know upfront what they're going to be. It's going to be something that we explore and we figure them out throughout the mortgage buying process. As a safe estimate, we like to say, like Donnie had said, as little as 3% down for first-time home buyers, but you're looking at a 3 to 4% extra that is encompassing of all those costs, escrows, closing costs, and prepaids. So all in all, at your best case scenario, you are looking at 6%, 7% of your purchase price that you're going to need to put down.
David, we got a question here from the audience. The question is, what's the difference between a pre-qualification and a pre-approval? I believe we actually have that answer to that coming up in one of our next slides. If we don't, I'll make sure to circle back and answer this question. So thanks, Nate, for the question.
All right. I believe it's in there as well, but just to jump to the next slide, and we'll get to that question here in a moment. A lot of people ask, what can you afford? And as Nancy was saying earlier in the presentation, talking about there's more than just your loan amount. You have taxes, you have insurance. You'll see mortgage loan officers will use what we call principal, interest, taxes, and insurance. It's kind of like your payment. And it is just those things. Your property taxes are paid on an annual basis. In Brevard County, that's in November. Okay, so we basically take whatever that annual amount is, divide it by 12. That's your taxes. Same with the insurance. We'll obtain homeowners insurance, whether you're refinancing or buying. And we just take that annual premium and we divide it by 12, and that gets included into your payment as well. One thing that does not get included to your payment, which I think causes a little bit of confusion, is the homeowners association. Same with condo dues. It is an expense that we look at when determining how much you can afford, but it is not actually something we will collect as a part of your payment. One more cost there that the next slide just kind of reminded me about is what's called private mortgage insurance. Private mortgage insurance is for those options for instance, first-time buyers who are only putting 3% down. anybody putting less than 20% down is going to have to pay what's called a private mortgage insurance. And all that is it's a insurance that covers the lender in case of default on the loan because they're not putting as much down as what used to be required, 30, 40 years ago. And it's calculated different depending on what you qualify for, whether you're a FHA buyer, conventional buyer, first-time home buyer. The amount differs between loans.
And then once they get then to 20% of the purchase price, does that insurance come off automatically, or do they have to do something to ensure that it's not deducted anymore?
So that's a great question, Nancy. So with private mortgage insurance, once the loan reaches 80% loan to value, the customer can then request that the PMI be taken off their loan. If it gets down to 78%, it'll come off automatically. This is on conventional loans that I'm talking about. But the answer to your question is yes. At 80%, the customer could then request that PMI to be taken off the loan. We just got a great question as well from Christy. Christy, thank you for your question. The question is PMI required for VA loans? The answer is no. If you are a qualified veteran, there is no PMI on your VA loan. So that's a great question, Christy.
Thank you.
All right, I think we covered most of what's in this next slide, talking about debt to income ratio. It's to go through it quickly. Debt to income ratio is simply all of your minimum day payments, just of what reports on your credit divided by your monthly income. We have guidelines. In most cases, you have to have 43% of that income can go towards debts as maximum. There are some cases where it can go up to 50%, but every case is different depending on credit score, how much you're putting down, how much the total loan amount is. All of that plays a different factor in how much your debt to income ratio can be. The loan to value is another term you'll hear when you talk to a mortgage loan officer. All they're referring to is what your loan is, the value of your loan or the principal balance of your loan divided by the home's value. So when we say put 3% down to purchase a home, that means you're going to be at a 97% loan to value.
Can I ask you, we were talking then about your credit score. So what's the highest FICO score you can have? And then what is the range that people want to shoot for in order? I know it depends on what range you're in, sometimes the interest rate that you're charged. So what is sort of the best to be in, or, where you're going to get a good rate for most people, then what range would that be with a FICO score? I know that's probably only one part of, what the loan amount, the percentage will be, but just so that people kind of have an idea of a good FICO score.
Yeah, so Nancy, so interest rates vary, product by product and by lender. So, everyone's qualifications are different. So to check out any of our products, definitely either contact David or myself, and we can certainly go over that with you. But most products that we have require a minimum credit score of a 620 or higher. So depending on the product, as long as you have a 620 credit score or higher, you're going to qualify for one of our mortgage products. There are other lenders or other companies out there that may go a little bit lower, although with COVID right now, we're seeing that's pretty scarce. Most lenders are starting at least 620, and some are even higher.
Yeah, the second side of that credit score is obviously 700 or higher is starting to get up into the better credit scores. 740 and higher in almost every product is basically, that's going to get you to the best rate possible with the best terms possible. As far as the highest credit score, depends on the bureau, but in most cases it's a 900. But again, just like we talked about earlier, there's different products for different, for an auto loan, for a mortgage, and they each have their own maximum credit score. But in general, you could think of it as a 900 as that maximum.
Thank you.
Right, and like I said, that's the reason I said to contact us about pricing or rates or what's the best credit score to get the best rate. Why I say to contact us for that are because different products have different either requirements or qualifications. For example, If you're a qualified veteran and you qualify under the VA loan, you're going to get the same rate whether your credit score is an 800 or a 620. It doesn't matter. If you qualify, you qualify. There's no loan level pricing adjustments, as we call them, or in other words, increases to the rate because your credit score might be lower. So there are programs that we have where as long as you qualify, you get the same rate, whether you're an 800 score or a 620. So just definitely contact us to go over any rates or pricing or things of that nature.
Yeah, so the next slide points out more of what we've been talking about, as you can tell, with the mortgage process. Talking to a loan officer, it's a flow. We start, we start with your credit and we move into the loans itself. So we've been talking about the different products. We do offer different products. TD specifically, with our conventional loans, we offer a 30-year term, and it's a fixed rate for the entire term. A 15-year term, which is a fixed rate for the entire term. And we do also offer lots of other products as well. Adjustable rate mortgages. We have what we call first-time buyer homes. We call them home ready or right step homes. It's there to help those with first-time buyers with good credit to have a low down payment and a good interest rate.
I do have to say, I think one important thing is for home buyers to work with their local bank. Like, they build a relationship with you, and you're here and they're able to talk to you, and they try and go online, and if there's any problem, you're trying to reach somebody, it's always a challenge. Whereas to have the local bank here being able to help you with your mortgage, I think it's more personal, obviously, but it's also a relationship that you're building up, and it's not just your regular accounts that are there, but when your mortgage is there too, I think it just builds on that partnership that you have, and I think that they have your best interest at heart, because they are here in the community and they're looking after the local people. So I just always suggest you talk to your local banks, your credit unions, mortgage companies. They make a difference.
Yeah, I agree.
Absolutely.
You're talking about, for most people, this is one of the biggest decisions you'll make in your life, or one of the most impactful financial decisions you'll do in your life. Electronics, whether it be the online, the computer, they're tools for us to use to help you get the loan, tools for us to make things easy, such as uploading documents electronically, or just being able to do something on the drop of the dime that you wouldn't necessarily be able to do if you were in a branch having to wait. But at the same time, you still have to have that personal connection. There are some things that just you can't understand simply through a video conference call or a phone call or an email. Sometimes you have to talk to somebody, and that's one of the things I like about the current lender that I work for, is that it allows us to do that. If you think of someone like Quicken Loans or some of these online retailers, they're huge and they do a ton of loans, but at the same time, you never meet that person. You never get to talk to them, and difficult questions, you end up talking to your bank anyways, and then you still end up going with them, but your bank could have helped you in the first place.
And not all questions come between 9 and 5. I can't tell you how many times I've had people express, they were always there to answer my questions anytime I had them. Customers have my personal cell phone number, and they call or text it. At all hours. Sometimes I'm not able to answer, but if I can, in that capacity to answer, I definitely try to answer right away. But some of those questions, pop into your head either late at night, early in the morning, or at times where it's not out just between the hours of 9 and 5. So one of the other benefits to dealing with a local lender is you get that personal service, that attention to detail, where we're there to help you and guide you through the process. A lot of times I tell first-time buyers, this process can be as simple or as complicated as you make it. There's a lot of guidelines, there's a lot of knowledge to know, and that's what our job is. Our job is to help hold your hand and help guide you through the process, each step of the way. So not only are you aware with what's happening with your loan application or what stage in the process it's at, but understand what's going on in that process. Understand what it is that we're doing to help guide you through that process and give you that personal service.
All right, to get to Nate's question from earlier, what is the difference between a pre-qualification and a pre-approval? The biggest difference between a pre-qualification and a pre-approval is the amount of verification that a application has gone through. So pre-qualifications are a phone or in-person application that we take with a customer, where we take your stated income, how much you might have for your assets, and we run your credit. Make sure you're credit qualified based on those qualifications. And that is your pre-qualification. A pre-approval is where we take it one step further. We actually have an underwriter review your income, and they review your assets to make sure that those are as you stated. And technically speaking, it makes it so it's a little bit more secure of a process. I'll have Donnie kind of go through that a little bit more in depth, but basically the pre-approval is something that doesn't happen as frequently anymore, and it has to do with overhead. I mean, banks, lenders, mortgage brokers, these underwriters are reviewing income and assets for a borrower who, in the end, may or may not actually find the home of their dreams. And maybe they want to wait until next year's primary buying season to see what homes come out. So it's a lot of overhead for a bank or a lender or a mortgage broker, or any of them, to be able to do a pre-approval, have underwriters review all this, and then in the end have nothing to show for it. So pre-qualifications have started to take over the industry as being the primary source of what we use to qualify someone. It's a letter that you use with your realtor to submit for an offer.
You know, and that's a good point to that, David, is, you know, some of the other larger online lenders, you know, not to name any names, but, you know, a lot of people that go through those lenders for their pre-qualification, you know, those pre-qualifications don't hold as much water when you're actually going to submit your offer, because the listing agent or the sellers see who that pre-qualification is through, and they know, you know, they're not dumb. They know that company, that lender, has not verified any of your documents. They haven't gone through any of your tax returns or your bank statements or anything like that to make sure that you are going to qualify. They basically just pull your credit, and as long as your score lines up and everything that you know you put application fits in the box, they just go ahead and send you a letter. So that's another one of the reasons why going through a local loan officer for your mortgages, you know, we go through everything that you submit over to us, whether it's your taxes or pay stubs or bank statements. And when we're submitting your pre-qualification or your pre-approval, depending on who you're going to use, you know, we look at all those things, and we make sure that as an experienced loan officer, we're looking for issues up front. And a lot of the times in the process, especially for first-time buyers, you know, it's not the end-all be-all. A lot of times by beginning the process can help uncover some needs that you need to take care of before actually going to submit an offer and go into application on a home. So during the pre-qualification or pre-approval process, we're looking for things like that may come up, any issues that we may need to address, or any corrections that need to be taken or action that needs to be taken before we actually give you your pre-approval or pre-qualification. So again, just contact your local mortgage loan officer, and we'll help you get on the right track to get you pre-qualified or pre-approved.
Well, can I ask, because the market's so hot, you know, a lot of the retail or realtors have been saying, you know, the cash offers are the ones that are kind of, you know, getting accepted, because it seems to be happening so fast. Homes aren't staying on the market very long, and they're getting multiple offers and over the asking price. So would that make it, would it be better then for somebody to say, hey, I want to be pre-approved versus pre-qualified, like go the extra step so that when they put their offer in, you know, the seller knows that that's a true qualified buyer? Would that make any difference or not really?
Yeah, so Nancy, you're absolutely right. And that can make a big difference. As long as that lender has the capacity. You know, what we're seeing right now is the real estate market is so crazy that lenders are experiencing the same issues. You know, we've got just as many loans that we're handling, you know, record number over what we have in the past. So the issue that we've run into recently is we just don't have the capacity. We don't have the amount of underwriters to be able to review the loans that are already under contract and the loans that just want to have their documents looked at for pre-approval. So, you know, that's where an experienced loan officer really comes in handy that can look at your documents and make sure that they don't see any issues. You know, and when we do submit that pre-qualification letter, you know, the realtors out there know which companies have actually done the due diligence and looked through all the documents and which ones are just looking at your credit score and submitting the letter. So yes, that is something that we're hoping to see here in the near future, is to have the ability, once again, like we did in the past, to be able to actually have an underwriter review and approve and clear all of those documents prior to the pre-approval. Typically that process does take longer than the pre-qualification because we do have to send it through underwriting, but we are hoping to see that here in the very, very near future. So yeah, that can add some strength. You are absolutely right, to someone's offer.
What adds more strength is having a local lender who is willing to talk to that realtor, both the listing agent, because when you submit a qualification to your realtor, they're handing it to another realtor who has to then explain to the seller, this is a good lender, or this is a, you know, a bad lender, or this is, you know, a weak offer, a strong offer. Having someone who's willing to be on your side, and not just your realtor, but your loan buying team, which I think might come up here in just a moment. But as a lender, we're a part of your loan buying team. So we are there, especially a local lender who will just jump on the phone. I'll talk to the listing agent. Hey, I have looked at their income. It might be a pre-qualification letter, not a pre-approval letter, but it is a strong one. We've looked at everything. I've gone through everything with them. We will have a conditional approval for you very quickly, and we will make sure that this is a qualified buyer. Goes a long way.
So David, we got a question. So Carolina, thank you very much for your question. When someone asks for a loan estimate and the bank checks their credit score, would that hit the score, or is it a soft check? And that's a great question. The answer to that question is anytime we check your credit, it is what's called a hard inquiry. So it will be an inquiry that stays on your credit. Inquiries stay on your credit, remain on there for 2 years. So before you have anyone, I don't care if it's a bank, lender, anything, if you're looking to apply for anything, you know, make sure that you've done your due diligence, you know, on that company, on that loan officer. Make sure it's someone that you want to work with, because yes, once the credit is checked for the loan estimate to be sent out, that is a hard inquiry. Great question.
All right, next topic within the process is the process itself. Now that we've figured out what you can afford, what your credit looks like, what kind of rates you're going to be looking at, there's the day you go under contract to the day you actually close on your home and move into your house. There's a lot of uncertainty there for those who have never been through the process. They don't know what to expect. In general, it's really pretty straightforward. We do collect documents to verify your assets, verify your income. There's things that come up on your credit that we might need to ask a question of. You provide a document and we collect it, we finish it. Overall, the process, depending on the product, is from 30 to 60 days. If you're purchasing a home, 9 out of 10 times you're gonna be able to do that in 30 days. When you're refinancing a home, because there's no actual closing date, most of the time that's gonna be between 45 and 60 days. Throughout that process, you'll be working with us, you'll be working with an appraiser, you'll be working with your realtor if you're purchasing a home, potentially a survey company, but also your title company who also serves as your closing agent. So you're gonna have a whole team that helps you out throughout this process. General things, more things that we do collect, as you'll see in these two slides, as far as pay stubs, A lot of people get concerned when we have to collect tax returns. It's kind of a hard thing for some to either want to provide or actually get, because a lot of people don't even keep their tax returns. It's not always needed. Unless you own your own company or you are a 1099 employee or you have rental income, we really don't have a need for your tax returns. That is purely for those variable types of situations. Any other sort of off situations you'll see in this next slide. We do loans for non-permanent or for permanent residents. You don't have to just be a U.S. citizen. If you are a permanent resident, we could do a loan for you as well. We will collect the documentation related to that. If you've had a bankruptcy in the past, doesn't mean you can't qualify for a new home, but we will collect documentation to verify when that bankruptcy was and kind of the details behind it. Same with a divorce or a foreclosure. Things that have big impacts on your financial standing, we will collect documentation in regards to that as well. Going a little bit into that team we were talking about, there's a lot of people that work on your loan. To start as the realtors help you find a house. The lender helps you get the loan. The closing agent is the one that will record the mortgage with the state of Florida or the county. You have a home inspector that's going to work with your insurance agent to make sure your home is safe and insurable. That we don't have any surprises 1 month later and a pipe burst that you don't know about. They'll do their best to try to recognize that before it happens. And then you have the appraiser who's going to tell you if that home is worth the price that the seller is looking to sell it for. They might be selling a house for $300, but it might only appraise for $250. So it's important that all of these pieces come together to make sure that you are making an informed decision on the house that you want to buy and that it is the home of your dreams.
So David, we just got another quick question. So the question is, David mentioned that you can have a loan if it's a citizen or permanent resident. What about investors out of the country? So that's a great question, and that's a little bit more of a specialized question. TD Bank is what we call a cross-border lender. So we do have a product that's designed especially for our cross-border Canadian residents. So we do lend to Canadians. There are other companies out there that will do loans for other folks that live primarily out of the country and are looking to buy here. Those loan programs are called foreign nationals. So we do not do loans we don't have any products for foreign nationals, but there are companies out there that do. And we definitely have some great referral partners that we can help referral and source those out to. So for anyone in that kind of category or any questions about that, just get with us and we can help get you with the right people, even if it's not with TD Bank. But yeah, we definitely do lend to our Canadian neighbors to the north.
For the most part, that is the home buying process. There's a few frequently asked questions here that it's good to take a look at, see what's on the screen. It gives you kind of the answers. The biggest one I want to point out there is the points. A lot of people hear about points when it comes to mortgages. Not a lot of people know what these points mean. And points simply, in their simplest term, is prepaid interest. So if you were to buy a point on your home, that is 1% of the purchase price. So if you're buying a $100,000 house, 1 point would be $1,000. That's going to buy down your interest rate. It could be 1/8% that it buys it down. It could be 1/4%. Again, all the factors that we've talked about beforehand goes into that. So it serves the purpose of being able to, if the current market rate is 3%, you want 2.875 or you want 2.75, you can buy it down.
So David, just to piggyback on that, and also your percentage of points or how that's calculated is based on your loan amount, not necessarily the purchase price, because you may be putting down more money. But one of the other points that I want to make, see what I did there, pun intended. One of the other points to make on that is, are points worth it? And that's one of the conversations that we have with the customer is, if you do buy the points, how much are the points? What is the cost of buying that? The prepaid interest or the cost or the one-time fee to buy your rate down for the entire life of the loan versus how much it's going to save you in monthly payment. And what we do, the answer to that is how long you plan on staying in the home or how long you plan on having that loan open. If this is going to be your forever house or you see yourself being in this house for 30 years and taking the full 30 years to pay it off, a lot of times points make sense. They're not required, but what we do is we sit down and have a conversation with you about what the costs are for the points, how much it saves you in your monthly payment, and how long it's going to take you to recoup that money that you've paid out up front. Because after you've recouped that money, everything and all the time, every payment you make beyond that is money in your pocket. But you want to see how long it takes you for that break even to make your money make sense. So points are not required. A lot of times what we see in today's market with the rates and the market is volatile as it is at the moment, there are some sweet spots with points. So although they aren't required, sometimes it is a good idea to be able to get your rate down a little bit lower and go ahead and prepay for some of that interest up front.
That's one of the primary factors when shopping lenders as well. If you're comparing, TD Bank to one of the major banks or to a Quicken Loans or whatnot, look at the rate that you're being offered. If we're offering 3% with no points, but another lender is offering 3% with 2 points, that means you're paying extra to have that 3% with them where you're not paying it with us, or vice versa. Not to say that we're always going to be the lowest, but we tend to stay as competitive as we can in the market. But that is a great tool to use to compare lenders. The last slide I have here is really about the closing. It's the end of the loan. Whether you're refinancing or buying a home, the closing is where it's all said and done. So the closing happens with the closing agent that is usually determined by the seller. It'll happen at that location, given COVID rules and regulations, depending on where we stand at that point, whether they know they were doing some electronically, but for the most part, it happens at a closing table, at a closing agent's office. Typically, you will see your realtors will be there, the closing agent themselves will be there, and at times, the mortgage officers will also show up to your closing. Once you have closed on the home, the title company will record that mortgage, they will record the new title and deed, and you are now the owner of that home. Outside of that kind of wraps up the process from beginning to end. It's a lot. It is a lot of information buying a home. It's even with this presentation being almost an hour long, there's so much we did not touch on, just because there is so much information with going in it. One of the things that I'll have Donnie here talk about in a second is things that you can do with your loan officer to make sure you're getting all the information you need.
Absolutely. And like I said in the beginning of the call, it can be as simple or as complicated as you make it. But the real key is finding a loan officer that you're comfortable with dealing with, and that you can certainly get along with, and it's going to help give you the right information. So hold your hand each step of the way, and to let you know not only where your application is in the process, but what's happening at that stage, why it's happening, and help you to understand each step or each stage of the process. So as David said, there's a lot more to touch on. We didn't want to make you experts in just under an hour, but we did hope that you got something, one or two things that are a takeaway out of this, and learned something new here today. For any other questions or anything else, please reach out to David or myself or your local lender, and make sure that you're dealing with someone that you're comfortable in dealing with in shopping for your major purchase. If you are in the market or looking to buy a home here in the future, we wish you all the best. We hope you enjoy the process. It's a fun time, shopping for your new home, moving into your new home. It's exciting. We want to share that excitement with you. So help us, let us help you, make this a fun and an exciting experience. I hope everyone has a great day. All our viewers on Facebook, thank you for joining us. Everyone on Zoom, Nancy, thank you very much for having us. Hopefully we can look forward to meeting all of you in person again today, someday soon, rather than doing this through a web conference or Zoom call. But stay safe, and we'll be seeing you in the future. Take care.
Thank you so much, David and Donnie. That was absolutely informative and interesting. And I can't believe this was almost an hour. I mean, it really did fly by. So you held our attention and provided some great information. What we'll do is on the Facebook page, then we'll put your contact information with your, I don't know if you want email addresses and phone numbers so that people can reach out to you directly. And that way, when they're watching the live stream, they'll be able to contact you right away. So we'll get that on there as well. But thank